Hi there. Welcome to the closing bell on the 24th of May for me around midday. And we've had a bit of a reversal in some commodities, haven't we? Copper reaching a new all-time high and getting hammered, and gold also coming under some selling pressure just in the last few days. So I thought I'd just update you on those to give you a sense of what I'll be looking for going forward, so that you can either not freak out if you've got positions in that space, or be looking for opportunities down the track if we do see continued upside in, especially copper and gold. So this being the gold price, of course, very long term, I do just like starting off, getting a really big bird's eye view. 2000 into 2011, massive run. That major high there, very important and has been ever since. And, we got the huge correction, and then we've got the next leg higher in gold. So that's what I'm sort of looking at, where we've seen nice, strong uptrend, right? So that really is still in, nice, solid uptrend on a, multi-year basis. But, the way I look at things is that prices sort of move with a good impulsive trend, then often, tries to work out which way it's going and will oscillate around what I'd say is that point of control before the next leg higher. And then you often get another, either correction or what have you, and then another leg higher. So the way it looks on a chart is you often get these nice strong moves, and then, oscillation, which way is it going? Who knows? And then bang, it goes off on the next one. And then this one might just be a sell-off for a bit, and then off it goes, and then another sideways. So that's sort of how trends develop, and you get a sense of these sort of impulsive moves, and then lots of work done. Impulsive move, and then, oscillating around a midpoint. Impulsive move. Look, this was, big correction, but really you've got, a year or two going sideways, and you're sort of getting a sense of these periods of being out of balance and periods of being sort of in balance and oscillating around a central point. So that's really what is often going on. You can see again, then a range trade around a central point, again, wave higher, and this is where we come to what's been going on in the last few years. So, looking at that, if you have been following these along, and I do want to get a bit, more in detail for people who are interested in understanding at a deeper level what's going on. So I'm looking at these corrections once they occur. So you've got this very good impulsive move to the upside. Then you've got enough force going against that uptrend to see, a sizable correction. And that is often when you can set up a period of sort of indecision, where the bulls and the bears are sort of pretty evenly matched. So analyzing that price action is sort of looking at these corrections, and you can see that midpoint, which is, what I call that point of control, is sort of what I see as that gravitational point around which prices oscillate as the market tries to work out whether it's going to break out to the upside or fail and sell off. So in the end, it doesn't do either, and it just keeps sucking in the bulls at bad levels, falling back to the point of control, then shaking out the bulls here. There's your stop losses, get people bearish, false break, back to the point of control, again, get people bullish, back to the point of control. So these periods really are what stuff traders up. It's just, years of oscillating back and forth around that midpoint. the point of control. And, often, bulls are buying up in this area, bears are getting short in this area, and they're all getting shaken out of their positions if you don't understand what's going on. And when you're looking at prices breaking out, I've shown you this before, that often people look at ranges and just have a very linear sort of way of looking at it, saying, well, there's the range, and if it goes below the low, it's breaking out of the range. And if it goes above the high, it's breaking out of the range. And often what actually happens is you get periods of going outside the range, stopping everyone out, and then reverting. And even here it did it for a bit. But now we've got what could be this breakaway move out of that range with prices trending. But even so, in the short term, it's a bit overstretched. And this is where I look at those ranges and have a think about how these false breaks occur outside the range. So remember, all the trading over the last few years is happening in this range. So everyone, long or short, has to buy in this price level within that range. And often stop losses are placed. So people are short, their stop losses are above the range. And if they're long, their stop losses are below the range. And professionals know this, and often prices sort of head up and just continually shake traders out of positions. So what can happen is, once you've got that range set up, you've got all this work being done in the center of the range. I'm looking at areas outside the range where I often see a reversal going back to that point of control. And those areas are 25% outside the range, and also the 618, the 61.8%. That's a Fibonacci level outside the range. So the final sort of piece of the puzzle on that is when you're in this sort of mean reversion phase, and there's areas outside the range, both below and above, where you often see reversals in the price, which then can actually head back to the point of control again. There has to be obviously a line in the sand where you say, okay, the range is actually finished, and we really do have a serious trend going on. And so that is when it heads double the distance of the range. So if we've got this initial wave higher, a big correction, I'm looking at that range and saying, well, if prices do actually move the level of that range again to the downside, or that range to the upside, that is sort of my line in the sand, saying that, look, really that distribution is definitely finished. So looking at that, with what gold has done over the last few years, it's gone between 2,077 down to what, 16 or 1,700, let's say. So that has been the key range where all the trading's been going on. So the level double is 2,470. So that's just my final line in the sand saying, look, this trend to the upside really is on. It's on. And just note that the rally we've seen, this breakout to the upside in gold, it's been incredibly strong. It really has busted through, both of these levels where I usually expect to see resistance, as we saw here. A bit of a sell-off in gold there months ago. And, it just blasted off through that, giving you the sense that this upside momentum is really serious. But note that it didn't actually hit that level, which is double the range. My line in the sand saying that the range is dead. that the gravitational pull of this point of control around 1880 is finished, and we're on for another period of being out of balance and trying to find the next point of control around which prices will oscillate, as we saw back here, and then out of balance, and then in balance again, and now is it out of balance again and about to really take off to the upside. So having said all of that and either confused you or enlightened you, the point is that we haven't had total confirmation yet that that range is dead. Prices got whacked over the last few days from quite overbought levels, and you can see sort of trading back near that 2320 level, which is that level 618 outside the range. So there is still quite a good chance that we're in for a bit of mean reversion in gold. So, don't be surprised if there is more downside in the short term in gold, but that won't create a bearish situation quickly. If anything, the way I look at this is what used to be resistance for years is going to be pretty good support. So that's down around 2077, 2100. That's $230 lower than where gold is now. But I would call that a really strong level of support. If gold got hammered, I would expect there to be, at the very least, a good bounce off there. And if not, the beginning of a massive move to the upside from there. And also, we've got the long-term uptrend, 10-month exponential, well above the 20-month simple. And you can see how far prices got away from that 20-month. So, very overstretched in the short term. And even in a big, strong uptrend, you see mean reversion going on back to usually the 10-month exponential. And I'll show you in a second why I'm saying that. If the trend is strong, that long-term uptrend, it will bounce off the 10-month. So that's down around 2100 as well. And the backup plan is that 20-month. That's down around 2000. So going forward, I'd say really strong support in gold between 2000 to 2100. So looking at that, if we back up and look at the really long-term chart on gold, you'll see why I'm saying when gold prices really trend, they often will hold that 10-month exponential. So you can see here, went into long-term uptrend, and look at prices just hug that 10-month there, all the way, all the way. First time you get a monthly close below it is there, that 10-month, and we got a bit of a clear out, but remained in long-term uptrend, and then took off again, and watch prices, how they bounced off that 10-month exponential all the way up to the end of that rally before the final large correction that happened in 2011. So going forward, if we're thinking this might be on here for gold, what we want to see is if we do see this mean reversion from overbought levels, the strongest situation will be hitting that 10-month exponential and bouncing straight off it. And remember, as I said, we've got very strong support at that level that used to be resistance, which is the top of that range around 2077. So that would be the best outcome. If we do see, a sharp sell-off, the buying comes straight back in and then turns up. I mean, that will be the real sign that gold is really broken out and is trending. And you would just be saying, well, how far will it trend? So that's sort of the situation. It's not panic stations. It's just saying that, we haven't completely broken away, despite the fact it feels like we have. from that point of control around 1880. So you can just see a bit of work. Even, worst case scenario would be actually heading back there and bouncing. Stranger things have happened. But just making the point, no need to freak out with the weakness. If anything, if you haven't gotten on, that would be the best outcome, would be getting long some gold stocks on this correction and on a bounce off that major support. And then, yeah, if we are in a serious bull market, that is what will occur. So that's pretty much the view on gold. Let's have a look at copper very quickly. So this is the long-term copper price, and you'll know I carry on about false breaks occurring more than breakouts. Again, that's what stuffs up traders. Everyone loves to get bullish when prices break out to a new high, and the market is fabulous at getting people in and then shaking them out. So this is copper over decades. This $4.50 to $5 area has been resistance for a very long time and is proving to be resistance again for the moment. And just note, when we've had these pullbacks, when we've had the attempted rally through the all-time high and then the pullback, I mean, look at how big that crash was, really bad. Here's the next breakout to a new all-time high, and look at that, multiple year sell-off. Here's the next one, sold off for a few months, then had another go at the high, false break again, got absolutely creamed. And here we are having another go. So, on those odds, you're saying it's long-term uptrend, still very bullish. I think ultimately copper is going to break out above that level. And you're still thinking, though, that it's really had a very strong move from $4 to above 5. That's a very sharp move for copper. So, no surprises that we have seen some selling pressure coming in from what has been, very serious resistance for a long time. So yeah, I'm totally comfortable with copper selling off for a while. Obviously a line in the sand above that 520. If prices turn straight back up, head up through there, wow, that is telling you a lot about just how bullish copper is. But if I'm looking at the way prices usually move, usually have these large corrections, new wave, large correction. And you know that I look at these corrections and expect prices to often head back to the buy zone of the range, right? Where I've got this wave higher, and I'm looking at that sort of 75 to 87% retracement area as well. If it can bounce off there, it can look all right. So you can see big correction down near that area, turns back up for the next wave. And, is this now the beginning of a corrective phase where we could see some sort of correction of this next wave? So, from that point of view, it may not get down there, but it can remain bullish and sell off all the way to $4 and still look good. And we've got long-term uptrend there. I don't think it's going to fall all that way, but, stranger things have happened. Markets love to do this, get everyone bulled up and then shake them out and then go again. So that's sort of a big picture. You can remain bullish on copper all the way to really that previous low, which is around 360 for copper. So until I see copper prices actually head below that level, I'm looking at this as an opportunity on the correction. How long it takes, who knows? It can stuff around for ages. after an impulsive move like that. But you're looking at some sort of mean reversion coming up in copper, and it will find the buying support somewhere, maybe that point of control there, 440 back up, or if it even goes further, still looking at this as very bullish longer term for copper, obviously with the fundamental situation. So situation really is, again, not freaking out just because we're seeing this short-term selling pressure makes sense, new high, aware of the fact that it can correct a long way, but I don't think we're in that sort of a situation at the moment. So getting ready, I guess, and allowing this overbought situation to correct. And, if you believe in the story, that's when you're really starting to load up on some copper exposure. So that would be enough for today. I think we could see a bit more downside in these commodities in the short term, but the big picture is certainly looking a lot rosier than it has been. All right, cheers. I'll come back with more next week.